From the heart of the nation's capital, this is the Evening News. Breaking news starts now.
At 4:47 p.m. on a quiet Friday in early January 2026, while markets drifted higher and television anchors reassured viewers that the soft landing was intact, a document slipped into the US Securities and Exchange Commission's database that may one day be remembered as a geopolitical turning point rather than a financial footnote. The filing was dry, technical, and legally mandatory, a Form 13F. But inside it was a decision so stark that it cut through the noise of earnings forecasts and rate speculation like a siren. The Bill and Melinda Gates Foundation Trust had just sold roughly 2/3 of its Microsoft holdings in a single quarter, reducing its exposure from nearly 30% of the portfolio to roughly 12%. According to the Q3 2025 filing submitted to the SEC in November 2025 and widely reported by outlets including The Economic Times and Yahoo Finance. This was not a symbolic trim. This was an exit of scale, and it did not happen in isolation. Within weeks, as analysts dug deeper into SEC filings covering the period from July 1st, 2025 through January 15th, 2026, a broader pattern emerged. Jeff Bezos sold approximately $8.5 billion worth of Amazon shares in just 9 trading days, a pace unprecedented in his own history. Mark Zuckerberg offloaded roughly $500 million in Meta stock. Jamie Dimon, the CEO of JP Morgan Chase, sold $150 million of his bank's shares for the first time since 2005, a fact confirmed by JP Morgan disclosures and covered by Bloomberg and CNBC. Warren Buffett's Berkshire Hathaway, meanwhile, continued a 3-year streak of net equity selling, amassing a cash and treasury bill hoard of approximately $325 billion by the end of Q3 2025, as stated in Berkshire's own quarterly report. Added together, these transactions represented roughly $89 billion in insider and founder-linked stock sales over 6.5 months. The numbers are not speculative. They are sworn, legally binding disclosures. What makes this moment explosive is not merely the money leaving equities, but where it is coming from and where it is going. The sales are concentrated in technology, consumer discretionary, and financial stocks, the very sectors that dominate US market capitalization and underpin American economic power. At the same time, the reallocation is flowing into assets that look less like growth bets and more like geopolitical hedges: railroads, waste management firms, utilities, and vast pools of cash parked in US treasuries. Gates increased exposure to Berkshire Hathaway, Waste Management, and Canadian National Railway, companies whose revenues depend less on consumer optimism and more on the continued functioning of physical infrastructure. These shifts, confirmed by Fintel portfolio data as of September 30th, 2025, suggest a worldview in which stability, control of logistics, and resilience matter more than innovation narratives. This is where finance stops being a market story and starts becoming a geopolitical one. Railroads are not just boring dividend machines, they are arteries of national economies, critical to food distribution, energy transport, and military logistics. Waste management companies operate under heavy regulation and near monopoly conditions, tied directly to state and municipal governance. Cash in treasuries is not idle. It is optionality, power deferred until a crisis forces assets into distress. When the world's most informed capital reallocates toward these instruments, it signals expectations about stress, not abundance. The timing matters. As of December 2025, the US unemployment rate had risen from 3.6% in April to approximately 4.2%, triggering the Thumb Rule recession indicator, a metric cited by economists including Claudia Thumb and tracked by the Federal Reserve. Credit card delinquency rates climbed to around 6. 8% in Q3 2025, the highest since 2011, according to Federal Reserve Bank data. Corporate debt to GDP hovered near 110%, exceeding pre-2008 levels. Commercial real estate valuations in major US cities fell between 30 and 50% from 2019 peaks, as reported by the Wall Street Journal. These are not abstract risks. They are measurable fractures in the economic base of the United States and, by extension, the Western-led global order. At the same time, geopolitical pressures intensified. The war in Ukraine dragged into its fourth year. Conflict in Gaza destabilized the Middle East. US-China relations hardened through tariffs, export controls, and technological decoupling. Supply chains that once assumed frictionless globalization now face fragmentation and national security scrutiny. In this environment, capital that once chased growth is increasingly seeking sovereignty, resilience, and insulation from shocks. Publicly, none of the actors involved declared a crisis. There was no press conference from Bill Gates warning of collapse, no letter from Jeff Bezos predicting a crash. Instead, there were filings, quietly time-stamped and legally precise. The contrast between what is said and what is done could not be sharper. Financial media continued to debate valuations and rate cuts, while the custodians of enormous private power repositioned for a world that looks less integrated, less predictable, and more contested. This is why the Gates sale reverberates far beyond Microsoft's share price. It is a signal about expectations for the next phase of global competition, a phase where control over physical systems, cash liquidity, and defensive positioning outweighs the promise of perpetual technological expansion. If capital is the ultimate vote of confidence, then the vote being cast here is not for acceleration, but for endurance. And as markets remain calm on the surface, one question hangs in the air, unanswered but unavoidable. If the people with the deepest data and the longest horizons are preparing for turbulence, what exactly do they see on the horizon that everyone else is being told not to worry about? The next set of filings will begin to answer that question, and they may reveal that this quiet financial shift is only the opening move in a far larger geopolitical realignment. What makes the recent wave of elite capital movement so unsettling is not the fear of a market downturn alone, but the unmistakable way it mirrors strategic behaviour normally seen before geopolitical shocks. When private capital begins to behave like a state actor, prioritising logistics, resilience and optionality over growth, it is rarely about quarterly earnings. It is about power in an unstable system. By late 2025, the United States equity market appeared calm on the surface. The S&P 500 hovered near record highs. Volatility indices remained subdued. Central bankers continued to speak of balance and normalization. Yet beneath that surface calm, the world's most connected investors were acting as if a period of systemic stress was not only possible, but probable. This divergence between narrative and behaviour is where the geopolitical signal becomes impossible to ignore. Consider where the money was pulled from. Technology stocks, particularly those tied to artificial intelligence, cloud infrastructure, and consumer platforms, had become not just financial assets, but symbols of American dominance. Microsoft, Apple, Nvidia, Amazon, Meta, Alphabet, and Tesla together accounted for roughly 32% of the S&P 500 by late 2025, according to S&P Dow Jones indices. This level of concentration had not been seen since the Nifty 50 era of the early 1970s, a period that ended with stagflation, oil shocks, and a brutal equity repricing. When Gates reduced Microsoft exposure by more than half in a single quarter, as confirmed by the Q3 2025 SEC filing, it was not simply a valuation call, it was a reduction of exposure to a pillar of US technological hegemony. At the same time, the reallocation targets tell a more revealing story. Railroads, waste management, utilities, and cash are not sectors associated with optimism. They are associated with continuity under stress. Canadian National Railway, one of the Gates Foundation Trust's major holdings, operates a transcontinental network connecting the Atlantic, Pacific, and Gulf coasts. In geopolitical terms, rail is strategic infrastructure. It moves grain, energy, military equipment, and industrial inputs regardless of sentiment. Waste management, another core holding, operates under heavy regulatory protection and near-monopoly conditions in many regions. Trash collection does not stop during recessions, pandemics, or wars. It is a civic necessity. Berkshire Hathaway, effectively a diversified proxy for the US real economy, combines insurance, energy, transportation, manufacturing, and an unprecedented $325 billion cash reserve as of Q3 2025. Holding Berkshire is not just an investment, it is a bet on resilience through chaos. This pattern aligns closely with the broader geopolitical environment as of early 2026. The war in Ukraine had fundamentally altered Europe's energy security and defence posture. NATO countries increased military spending, diverting fiscal resources away from social and growth-oriented programs. In the Middle East, the conflict in Gaza destabilized regional trade routes and increased the risk premium on energy and shipping. Meanwhile, US-China relations continued to deteriorate. Export controls on advanced semiconductors, restrictions on outbound investment, and retaliatory measures from Beijing signaled that the era of frictionless technological globalization was over. According to data from the US Department of Commerce and reporting by the Financial Times in late 2025, cross-border technology investment flows had already begun to slow sharply. In this environment, growth narratives become fragile. Artificial intelligence, while transformative, is capital-intensive. Microsoft, Amazon, Google, and Meta collectively spent more than $200 billion on AI-related capital expenditures over the previous 2 years, according to company earnings reports and analyst estimates cited by Reuters. Yet free cash flow growth lagged. Microsoft itself reported strong revenue growth, but declining free cash flow in mid-2025 due to surging data center and infrastructure costs. From a geopolitical lens, this raises a critical question. What happens if the technological arms race becomes a fiscal burden rather than a profit engine? For investors with long horizons, the answer appears to be de-risking before the bill comes due. Credit markets reinforced this caution. By late 2025, US corporate debt stood at approximately 110% of GDP, higher than before the 2008 financial crisis, according to Federal Reserve data. As interest rates stabilized in the 3.5 to 4% range, debt issued at near-zero rates during the pandemic began rolling over at much higher costs. High-yield credit spreads widened. Defaults in commercial real estate-linked debt increased, particularly among regional banks exposed to office properties whose values had fallen 30 to 50% from 2019 levels, as reported by The Wall Street Journal. For insiders with access to private credit data and loan books, these were early warning signals of contagion. Insider behavior confirmed it. In December 2025, the ratio of insider selling to buying reached approximately 4.7 to 1, according to aggregated SEC data cited by MarketWatch. Historically, similar ratios were observed in 2007, just before the collapse of Lehman Brothers. While insider selling alone does not cause crashes, it reflects expectations. CEOs, CFOs, and board members sell when they believe future risk outweighs future reward. From a geopolitical perspective, this is how elites hedge against instability. They do not wait for official declarations of recession or conflict escalation. They move capital into assets that preserve control and flexibility. Cash is not cowardice, it is leverage. Infrastructure is not boring, it is power embedded in steel and concrete. When these preferences emerge simultaneously across multiple billionaire-controlled entities, the signal transcends individual portfolio management. What we are witnessing, then, is not merely a rotation out of tech. It is a quiet acknowledgement that the global system is entering a more contested, less predictable phase. Supply chains are fragmenting, debt burdens are rising. Political risk is no longer confined to emerging markets. In such a world, growth is optional, but survival is not. And as these moves continue to ripple outward, one unsettling implication comes into focus. If private capital is already preparing for systemic stress, what happens when public institutions and ordinary investors are forced to react rather than anticipate? That question leads directly to the final, most uncomfortable dimension of this story: the point at which financial repositioning turns into social and political consequence. By early 2026, the pattern is no longer subtle. What began as a series of quiet, legally required disclosures has evolved into a structural signal about how power is repositioning itself ahead of instability. The sale of assets by figures like Bill Gates, Warren Buffett, Jeff Bezos, and Jamie Dimon is not remarkable because of the headlines it generates, but because of the asymmetry it exposes. On one side are institutions and individuals with near-perfect visibility into economic stress points, credit markets, supply chains, labour data, geopolitical risk briefings. On the other side is the public, still consuming a narrative of reassurance, still told that volatility is temporary and that long-term faith will be rewarded. History shows that this gap is where trust breaks. In 2007, insider selling surged months before the collapse of Bear Stearns and Lehman Brothers, a fact later documented in post-crisis investigations and SEC data. In early 2020, large funds quietly raised cash before the pandemic shock reached markets, while public messaging emphasized containment and calm. Each time, the same sequence unfolded: private preparation, public surprise, and finally, social backlash once the costs became visible. The current moment carries the same structural fingerprints, but with higher stakes. The geopolitical environment magnifies the risk. Governments are more indebted than at any point since World War II. Political polarization limits the ability to respond quickly or decisively to economic shocks. Strategic competition between major powers has turned technology, energy, and even food supply into instruments of statecraft. In such a world, market crashes do not remain financial events, they become political accelerants. Rising unemployment, shrinking retirement accounts, and falling asset values translate into anger, protest, and institutional strain. This is where the billionaire repositioning becomes ethically charged. Legally, there is nothing improper about selling stocks or holding cash. Form 13F filings exist precisely to ensure transparency after the fact. But transparency delayed is not the same as shared foresight. When those with the most information exit risk early and those without it are encouraged to stay invested, the result is not just wealth transfer, it is legitimacy erosion. According to Federal Reserve data, over 60% of US households' market exposure is tied to retirement accounts and passive funds. These investors cannot move with the speed or precision of private trusts. When downturns arrive, they absorb the shock last and recover slowest. The implications extend beyond finance. If markets correct sharply in late 2026, as some analysts privately fear, governments will be forced to choose between stabilizing asset prices and addressing social fallout. Bailouts, stimulus, or emergency measures may once again favor institutions deemed systemic, reinforcing perceptions that the system protects insiders first. The result is a feedback loop. Declining trust leads to political volatility, which increases economic risk, which drives further elite hedging. Yet there is a deeper message embedded in the current silence. The shift toward cash, infrastructure, and defensive assets suggests an expectation that the rules themselves may change. That capital may need to operate in a world of capital controls, trade barriers, or sudden regulatory interventions. In that sense, the Gates sale is not just about Microsoft or valuations. It is about preparing for a future where flexibility matters more than optimism, and where power is exercised through preparedness rather than prediction. This brings us to the uncomfortable truth at the center of the story. Crises do not arrive because no one saw them coming. They arrive because those who did see them coming moved quietly, while everyone else was told to stay calm. The filings are public, the data is available, the actions are documented. What remains uncertain is how society will respond once the consequences of those actions become visible. The larger message is not that a crash is inevitable, but that the architecture of response is already being built, by a few for themselves. And the question that now confronts the public is not about timing the market, but about trust itself. In a world where foresight is concentrated and silence is strategic, who is the system really designed to protect when the next shock finally hits?